When you're buying a business, one of the biggest early decisions you're going to have to make is whether you're doing it as an asset sale or a stock sale. Trust me, this isn't some boring legal technicality. This is something that can have some big implications for you for years to come. Taxes, liabilities, and even whether or not you're stuck for paying for somebody else's mistakes. In this video, I'll break down the difference between an asset sale and a stock sale and why one is better than the other. Stick around, we'll jump right into it.
Welcome to the Power of Biz YouTube channel. My name is Tim Delaney, and over the past 11 years, I've purchased businesses and real estate to build my financial independence. My journey began with buying my first business with just 10% down, and through hard work and strategic decisions, I've been able to create the life that I want. I started this channel to share my story and experiences with the hope that I can help you do the same. Whether you're looking to break free from the 9-to-5 grind, build long-term wealth, or take control of your financial future, you're in the right place. Join me as we explore the ins and outs of buying businesses, the challenges and rewards, and the practical steps you can take to create the life you desire. Together, we'll navigate this exciting journey to financial freedom.
So, what's the difference between an asset sale and a stock sale? Let's start with an asset sale. In an asset sale, as the buyer, you are purchasing all of the assets of the business. That's inventory, equipment, the name of the business, phone number, website, all the digital assets, any intellectual property, existing customer contracts, customer lists. Basically anything that the business owns that is an asset to that business, including even the goodwill, which is kind of the intrinsic value of the company that you're buying from the previous seller. Those are all assets that you are buying in an asset sale. What you're not buying in an asset sale is the liabilities of the business. So if you're familiar with a balance sheet, there's assets, there's liabilities, and there's owner equity. Those liabilities are going to stay with the seller in an asset sale. A stock sale, on the other hand, is when you're purchasing the shares of the business, the entire business. So that includes the assets and the liabilities and any equity in the business. That means that you are responsible for all of the outstanding payments, all the outstanding payables. That means you are responsible for any outstanding liabilities, any potential liabilities that might not even be known yet to the seller, or that the seller might be actively hiding from you. So in an asset sale, you're buying just the assets, no liabilities. And in a stock sale, you are buying the entire business, everything associated with the business, including those liabilities. And this can be even things that come up down the road. Maybe the company made some defective part, or maybe somebody gets hurt or sick, or whatever the case may be. In the future, off of something that the company did in the past, they can still come after you because you now own that business and you purchased it as a stock sale. Versus when you buy it as an asset sale, that liability still rests with the previous owner because that's their liability, which is one of the reasons that I typically recommend an asset sale. So you don't want those unknown liabilities, especially, to be over your head for the foreseeable future. You don't know what might have happened or not have happened. The seller might actively be hiding something from you, but even if they're not, things can happen, things can come up down the road that you are going to be responsible for if you do a stock sale. With the asset sale, you're not. You're safe, you're protected. Sure, if a customer has an issue with something that was purchased under the previous seller, you might need to take responsibility and help them out with that issue because you want that customer to be in good standing going forward. But it's not like a major lawsuit or a big bill that was not paid by the previous owner that all of a sudden surfaces after you've closed and you had no idea about it. Those things would stay with the seller in an asset sale. So why would a stock sale even come up? Why is it even a thing if I'm telling you that there's such big risks involved with it? Well, in some businesses and in some situations, it just makes sense because of certain criteria. So there are businesses that have very specialty certifications or licenses that might not be transferable to a new owner if the ownership entity changes. So if the entity stays the same, but one person now owns the stock instead of a different person, those certifications and licenses might stay the same, won't be affected. Versus in an asset sale, the new owner might need to go through that whole certification or licensing process on their own. And that, depending on the type of industry, that can take years to get. Another reason is certain customer contracts might not be transferable to a new ownership in an asset sale. This is particularly the case with government contracts. A lot of government agencies have no transfer clauses in their contracts because they don't want companies just pawning off the business on other people. So if you do an asset sale, you might have to go through a long, arduous process with the government agency that's contracted you to make sure that you're still going to maintain that contract after the sale. Versus with a stock sale, it will just transfer over because the entity structure did not change, and for all anybody knows, the company is just still running as is. Nobody even has to know that the ownership changed. Those are some of the reasons that a stock sale would be beneficial to you as a buyer. There are also reasons that a stock sale is beneficial to a seller from a tax perspective. So sellers will typically prefer a stock sale if they can get one, because they're going to be paying taxes differently on that sale than they would as an asset sale. Most small businesses, though, the sellers do understand that a buyer is typically going to insist on an asset sale, and if they want the dollars that they expect, they're going to have to go with that. Another case where a stock sale might come up is in a gradual ownership change. So if this happens sometimes with employees or an employee of the company or a parent-child situation where there is a gradual change in ownership where, okay, year one, the buyer buys 10%. Year two, they buy another 10%, and so on, whatever those percentages are. That is much easier to handle in a stock sale than an asset sale. So that gradual ownership transition would be another reason that a stock sale would come up. Let's say that you do have a situation where it makes sense for you as a buyer to do a stock sale. So how do you protect yourself in that situation? Start with extreme due diligence. In any business purchase, you want to make sure you're doing your due diligence. That means digging deep into the financial records of the company. If you can, talking to customers, talking to vendors, talking to employees, making sure that what you're buying is what it appears to be. This is especially the case in a stock sale. You want to make sure that those vendors are all up to date and things are good with them. Make sure that there's no outstanding liabilities. Look through old records. Make sure the bills were paid years ago. Because sometimes even if the seller might say, oh yeah, that was taken care of, it was a misunderstanding, that vendor might come back out of the woodwork if they find out there's somebody new in charge and that they think they have a chance of collecting on something. So make sure you're doing extreme due diligence if you're doing a stock sale. Strong indemnification clauses. In any business purchase, you need and want an attorney on your side working with you. But especially in this case of a stock sale where you need a good indemnification clause, which makes the seller responsible for certain past legal claims and issues. So asset sale is an easier way to protect against this, but a good indemnification clause in a stock purchase sale could help protect you as well. It's not as airtight, there's still potential issues, but you can put it in the contract that the seller is still responsible for all past liabilities. You could ask for a escrow account or holdback of some sort that some money stays in an account for a certain defined period of time to make sure that nothing outstanding pops up or that certain bills are paid that shouldn't have been your responsibility, that belong to the seller, that maybe weren't directly involved with the operations of the business. It's going to be a tough card to get over on a seller, but it is something that could be done in certain cases to put everybody at ease, especially if the seller is very insistent on a stock sale versus an asset sale. So even with an asset sale, there are some hidden risks that you need to be aware of. As with buying anything really, but especially in a business sale, you're going to want to pay attention. Even though the seller is going to be responsible for all past liabilities in an asset sale, you still want to make sure that those past liabilities are not going to affect you and the way you're operating your business. So, quick story here. When I purchased my wine and liquor store, I did it as an asset sale. So I set up a new entity. I had to go get a new liquor license, which, it's one of those things. So it wasn't a extremely arduous process. It's definitely time consuming, and it delayed closing for a couple months while I went out and got that liquor license, because I couldn't close on the sale until I had the liquor license ready to go. Otherwise, we would have had to close the store for a period of time. We didn't want to do that. So, new entity, I had to set up new accounts with all of the vendors, because now I have a new liquor license number, a new tax ID number. Even though the name of the store was staying the same, it's technically a new entity. In New York State, we buy wine and liquor on 30-day net terms. That means if the wine and liquor is delivered today, I have 30 days to pay that bill. As long as I pay my bills and I'm in good standing with the vendors, with all the vendors in New York, I have the 30 days. The previous seller was in good standing with all of their vendors. They had 30-day terms. So a few days before we finalized the sale, because they had to keep the business ongoing, they were still ordering new inventory. So every 30 days from the delivery date, they would pay the bills that were due. That's what they were used to. We closed on the sale. They were going to get a check, but it would take a few days to clear. And in their mind, I'm setting up a new account. I'm going to take delivery on new products the day after I close, and I'm going to have my 30 days to pay those bills. In their minds, and my understanding, they would have the 30 days from their last delivery to pay their bills as they came in. Well, a problem arose when I tried to place an order with a couple of the vendors. Is they said, well, the previous entity that ordered supplies from us is no longer in existence, and they still owe us money, and we will not ship to you on credit until we get paid in full, because now we have nothing to hold over that entity. So in theory, the sellers could have really screwed me by never paying those bills, and the vendors would have taken it out on me because they had no other means of collecting other than taking them to court and eventually getting their money. But in the meantime, they could have made my life really difficult because I would have had to buy everything on COD, cash on delivery, which would have changed my business plan a little bit. I would have needed much more working capital right up front instead of having those 30 days to pay my bills. So even though it was an asset sale, and even though I wasn't technically responsible for any of those outstanding liabilities, it was something that came up. So just make sure that you're paying attention to all the little details like that during the sale process. Have those conversations with the vendors much earlier. I mean, I was already in communication with the vendors because I was setting up a new entity anyway. It was something that nobody ever really thought to ask, but it is something that did come up. The other things that you want to look at before closing is make sure that if you have any very large customers, big customers, make sure those contracts are transferable. Like I said earlier, one of the reasons you would do a stock sale is if you can't transfer those contracts. But making sure that with the asset sale that those contracts are transferable, and make sure the customers are happy. Even if the contract says it's transferable, if the customer is not happy and maybe they're looking for an out, maybe they'll use that as an excuse. Even if legally and technically they're not supposed to get out of it, they might try. And even that trying period of them not paying you could really impact your profitability and your revenue in the short term. So make sure they're happy, make sure everything's good. Employee payroll and benefits, making sure that you're legally set up and ready to hire your employees from day one. So again, you have a new entity, you are a different employer than the previous seller. So you need to make sure that all of that is ready to go. Make sure that you're legally able to employ people in your jurisdiction, and that's all set up, ready to go. You have the proper insurances and all that stuff. Technology and systems, making sure that whatever technology you might be relying on from the seller is transferable to you. Or if you're transitioning into new technology, making sure that you have those licenses and everything ready to go from the beginning as well. Finally, there's some legal and tax considerations for both asset sales and stock sales. You absolutely want to talk to an attorney and a CPA before, during, and after your sale. So ideally, even before you make an offer, you should have a conversation with both. During the process, make sure you're having conversations with both. And after you close on the sale, make sure that you're having conversations with both. Ideally, you want to get both of them on the phone at the same time, because an attorney and an accountant are looking at your situation from two different perspectives. The attorney is trying to protect you legally, liability-wise. The accountant is trying to find the best tax situation for you. And sometimes those things are kind of at odds, and you need to figure out which is going to be best for you, both entity structure, allocation of assets, and all those kinds of things. So in an asset sale, you want to make sure that your CPA, first of all, you want to make sure you're setting up the right legal entity to make the purchase, whether it's an LLC, a partnership, whether you're designated as an S Corp, whether you buy it as a C Corp, all these different types of things. And that, again, attorney and accountant. When you're making the purchase, in the purchase and sales agreement, you want to make sure that your CPA is weighing in on how to properly allocate the purchase price to different assets. There are certain assets that can be depreciated very quickly, and there are certain assets that cannot be depreciated at all. Depreciation is a non-cash expense that can help reduce your taxable income from operating a business. So it's good for you in the beginning to help offset some of your profits so you're not paying super high taxes. So you want to make sure that a CPA is allocating stuff like equipment and inventory and goodwill as opposed to land or certain building types that are going to be a longer depreciation schedule. In a stock sale, you're going to be inheriting the seller's tax basis on those items of equipment and buildings and goodwill. There is no goodwill. So you're not going to be able to use the depreciation in a stock sale to that extent. If they still have items that they might, maybe a big piece of equipment that they purchased recently, it might still be being depreciated, but they might have depreciated it fully already, even if it was just purchased in the last couple of years. So you're not going to get that benefit of depreciation to help offset your profits. So another reason that a stock sale is not necessarily favorable. Some final thoughts. Whenever possible, as a buyer, you are wanting to push for an asset sale. This is the best situation for you from a liability standpoint and also a tax standpoint. When it makes sense, do a stock sale, but only if there are very strong reasons for needing to do it that way. Otherwise, you could put yourself in a bad liability situation and possibly a bad tax situation. Something that if you're using it as a negotiation point with the seller that's insistent on that, and you can get a crazy good deal on the business, maybe it's worth it. But in general, try to push for the asset sale as much as possible. Do your due diligence, talk to as many people involved as you possibly can, and making sure that you're buying what you think you're buying and that everything is running smoothly for your transition. Hope this has been helpful. If you've gone through this process before, whether an asset sale or a stock sale, I'd love to hear your experiences in the comments, whether I described them accurately, what challenges you faced in buying a business, or what challenges you faced in thinking or about buying or making offers in the past. Let me know in the comments below. And if you found this helpful, please make sure you hit the like button, subscribe to our channel, and stay tuned for more business buying tips. Thanks very much for joining me. Cheers.